Foreign appetite for China's yuan-denominated Class A shares has recovered as equity markets rose after a three-year decline and regulators stepped up moves to make the country's capital markets more friendly to foreign investors. The confidence has not come to the average individual investor, but the number of large-sum institutional investors has helped with the A shares. Financial traders qualified in the Qualified Foreign Institutional Investor Program opened 104 accounts to trade A shares from January to November this year, up sharply from just 24 entries for 2011. The Chinese regulators have relaxed rules and qualifications for investing institutions. Recently, the State Administration of Foreign Exchange abolished the $1 billion ceiling for sovereign wealth funds, central banks, and foreign monetary authorities participating in QFII. No new upper limit was specified, but QFII applicants still must apply with a quota limit. Launched in 2002, QFII is a control for foreign institutions to access China's yuan-denominated markets. In the past decade, the program has witnessed a more than tenfold expansion in both the number of participants and the size of approved investment quotas. According to Lipper, the A-shares market lost 25.3% of value in 2011 and 9.1% this year. A significant portion of that market value loss was due to QFII funds selling off big chunks of stocks. Some of those fund managers are making purchases because they believe the markets have bottomed out. The valuation of Shanghai's stock market on December 3rd declined to its lowest level since 1997, with a price-to-earnings ratio of the index at 10.8 times, according to data compiled by Bloomberg News. That makes the Chinese stock market more attractive in light of the insecurity of the fiscal cliff in the U.S. and the continuing debt crisis in Europe. Thomas Franzen, chief investment strategist at the Second Swedish National Pension Fund, which received approval to become a QFII participant in September, said that now is a good time to invest in the Chinese stock market because the current valuation indicates considerable returns in the future. Investment sentiment in China has been further buoyed by the stock market's recent rebound. Between December 3rd and December 14th, the Shanghai Composite Index has surged above 10% from a near four-year low. Christina Chung, head of Alliance Global Investors China team in Hong Kong, said they expect a mild rush from QFIIs to put more back into the Chinese market. Market watchers and investors are upbeat. The market's current positive performance will continue into the new year as China's economy gathers pace after 7 quarters of slower growth. Goldman Sachs is forecasting that the Shanghai Shenzhen CSI 300 index, a gauge of the performance of 300 stocks traded on the Shanghai and Shenzhen exchanges, will advance 26% next year. The investment bank recommended that overseas investors increase their holdings of A shares. An increase of 20 to 25% is hardly aggressive compared with other stock markets, said Lipper. But if that happens, it will signal the end of a bear market in China. They also say it's not impossible that China's market may replicate its 2006 to 2007 performance when the Shanghai Composite Index surged from about 1,000 points to a record 6,124.